Thank you all for coming. Right, Ben, it's the down arrow, right? Okay, this is very counterintuitive. Okay, here we go. Ben asked me to come along today to talk a little bit about the environment for investment, not just in the UK, but also mainly in the States, where the UK takes a lot of its direction and trajectory from, but also talk a little bit about the excitement that gets investors involved, increasingly involved in the high velocity type businesses. I'm going to try and give you a sense of what investors want to see. Is there anybody here thinking of raising money, or yeah, 1, 2, just 3? Any advance on 3, 4? Good. It's getting better. It just quadrupled there. Did you see that? Interesting. Okay. And I've got, I'm going to try and provide some texture around that, but also give you some mad predictions that you can take home with you. I used to prefer to give my predictions about 90 years in advance, so I wouldn't have to be around to explain myself, but I'm going to go balls out here this morning and give you the next 18 months. There we go. About 10 minutes to fill. I'm not going to give you trends. I'm not going to give you graphs. I'm not going to give you comparisons or multiples. I will take questions if you like on those. I'm going to give you loads of numbers, all right? And I'm going to share a few nuggets with you. I think they're nuggets, but they're observations that I think if you are in the business of raising money, or know anybody who wants to raise money, or in fact are part of this whole wonderful London tech culture that's going on right now, I hope you find this interesting. I've also got some prizes as well, which are books that I've written that I just have to give away. The publisher told me recently that the recent one is going so well they're going to print another one, which I think is good. Okay, so a bit about us first of all. We're a specialist boutique advisor in what we call the time sector: technology, internet, media and entertainment. We are 5 years in business. I was formerly with Results, and the man who introduced me to Results 10 years ago is sitting in front of me, is Jim Sergei here, which is a pleasure to see him as always. So anything Jim tells you later on about me, just divide it by 2. There's some numbers straight away. We founded in 2010. We work on sell side, mergers and acquisitions, capital raising, increasingly do a lot of advisory work, and do a little bit of buy-side work as well. So we're people that are passionate about the digital tech space. We understand it, we've written books on it, and are increasingly becoming connected to the whole wonderful fabric that's going on around London at the moment. We've got a super database of over 4,000 investors in the UK and Europe, and anything else you want to learn about the company, talk to me afterwards or have a look at our website at Mediaventura.com. Right, so how come we've never had it so good? It's a very, very progressive market out there. I've never seen anything like it. I've been in corporate finance for over 10 years, and I'm telling you, it's not going to get much better than this. If you can't raise money right now, you should be concerned. In Q1 in the UK this year, there's £460 million raised in venture capital, which is 66% up on last year. You will see some deviation if you read different reports of Boris Johnson's stuff this week with Tech City, or even the Financial Times today, but it's broadly around that sort of shape, which is quite extraordinary compared to where it was 4 years ago. It's actually 20 times the level of money being invested now compared to 4 years ago. Last year, 1.4 billion raised in total, and that's set to create 20,000 more jobs, adding £100 billion to the UK economy. We've now got 3,000 businesses, again, depending on what you read, in the tech space, supporting 350,000 Londoners who work in this market. So this is not some sort of fad, as Ben referred to earlier on. This is really, really happening, and it's terrifically exciting to be part of all this. Also, we all know what unicorns are, right? Horses with spikes, okay? Good, okay. $1 billion valuation companies. So the UK is now leading the way in this. In the last year, there have been 10 new unicorns introduced into the EU. These are 10 new companies which have gone over the $1 billion valuation mark. To put it in perspective, though, the combined value of those unicorns, there's 40 in total now in Europe, okay? UK leading the way. There's been 10 new ones in the last year, all right? So the combined value of those 40 unicorns is now $120 billion. It's a great, big, fat number. It's only half the value of Facebook, to put it in perspective. And Facebook is only 1/3 of the value of who? Apple. Apple. That's a free book for that man over there. There we go. We're off. We're up and running. We're up and running.
I can't read.
Okay, which one? Blue, black, or red?
Oh, I'm a red.
Red. Okay, excellent. No one likes that one. There we go. Okay, yeah, Apple is worth 3 times what Facebook is valued at the moment. But the story in the EU is actually very exciting because there's a strong increase in the size of the fundraising deals that are going on right now. Transactions are up 53% in the last year. There's been 46 major transactions in Europe in the last year of $30 million plus. For fundraisers over $50 million in Europe, which represents about 37% of the total number of deals, it represents 59% of the value. So we're actually on a very positive upward trajectory. And what this means is, for the first time in the tech space, the EU and the unicorns in the EU have the resources and the strength to compete with where? USA. Good stuff. Okay, what's the average age of a EU unicorn founder? Anybody? Oh, no, a bit older? Okay, I'm going to put a book on this. 32. Who said 35? Ah, this lady over there. Okay. There we go. So the average age of EU unicorn founder, there we go, enjoy, is 35. Right, so generally a big feel-good factor going on. Are we all feeling a feel-good factor? No? Okay. All right. Here's another number to throw at you. Positive investor sentiment. What drives the stock market? What drives the stock market? Yeah, emotion. England managed to win a game of football against Germany. Yeah, you'll get that. England win the Ashes, you get that. You used to get it when an English player got through to the 3rd round at Wimbledon, but there's been Tim Henman since then, so it's not so difficult anymore. There is another dynamic going on right now, which if you don't know about it, you need to know about it if you're in this business. And that is the speed of technological change, which has been brought about by the internet over the last 20 years or 25 years, is now deeply affecting finance. It means that there's shrinking times between investment rounds. There's a shrinking time between investment rounds. It's not just the valuation anymore, which I think the Americans, in fairness to them, have actually realized very, very quickly. And I think we're realizing it gradually. But it's not about the valuation, it's about speed. Really one of the themes and one of the nuggets that I want you to take away from this conversation with you today is how important speed to market is, not just with your PR and communication strategy or your adherence to regulatory or legislative issues that are there, right? But you need to get this, right? It's not because you can raise the money quickly. It's because you now have to raise the money quickly to compete. That's really the big difference. LinkedIn did 3 fundraising rounds over 3 years, right? Big success. However, in the last year, there have been 20 firms in the States. And I'm going to use a lot of American numbers here, okay? You'll forgive me, I'll come back to the UK numbers shortly. But in 2013, since 2013, there have been 20 tech companies in the States that have done 3 fundraising rounds within 18 months. Okay, so that sets the bar for EU companies and UK companies. If you want to compete, that's the kind of speed and that's the kind of attention you need to draw from the market. Not just from fundraising, also from sales and commercial traction, but the other assets and the other strategies that my learned gentlemen over here have been talking about so far. Companies like ClassPass are worth a look in terms of their funding strategy. Have a look at that. Slack, the collaboration software, and Snapchat. And Snapchat just raised a whole bunch of cash, and then 3 months later, Alibaba came in with here's another $200 million. Right, so that's the level of activity that's going on right now. The CEO of Slack, Stuart Butterfield, said that it is simply the best time ever to raise money. Okay? It reinforces your position in the market, it deters competitors, but it sets you apart, and it puts you into that unicorn stable, right, where other investors want to join and want to get in there as well. I'm going to talk a little bit about this 18-month sprint. Have you heard of the 18-month sprint factor? It's all aligned to this. Ask me afterwards, and I'll give you a list of the companies right now that are classified as 18-month sprint companies. What's happening? FOMO. Do we know what FOMO stands for? Yep. Come on, somebody shout it out. This is the best. Oops, sorry. This is the best book I've written so far. He lied. There we go. Enjoy. Yeah, fear of missing out. After the dot-com crash and people lost all their paper money, certain things happened. Red tape, bureaucracy, compliance, governance. It became harder and harder to justify why on earth do we want to bother with an IPO? What's the point? So the IPO market has dried up considerably in North America, and I think it's giving us a message for the rest of the world as well. Why has that happened? Take a look at Amazon. Amazon did an IPO of $500 million, right? Since then, their investors have made 200 times their money back. Facebook, on the other hand, did an IPO at $100 billion, and even though their investors have doubled their money since then, right, the spectacular growth is all pre-IPO. All right? So you've got a deterrent for investors coming in at IPO, and you've also got a deterrent with the amount of regulatory work that's required to get to this stage. And I don't think investors see the attraction anymore of being part of the herd mentality. They want to be involved in the earlier stages, and that's great news for someone like me who can help people raise money and get to where they have to get to. So what's happening in America now is this, you may have heard of it, called a private IPO market. And I remarked on a gentleman from Benchmark Capital, Bill Gurley, who said recently at a Goldman Sachs technology conference that he was talking to one of the managers of a mutual fund who basically said to him, look, we're told that we can't invest in technology companies because it's outside the brief of the mutual fund to invest in technology companies. But what are we supposed to do? All our competitors are doing it. You've all heard this before. It's got this kind of dot-com sort of fascination, this sort of bubbling, building all around it. How long is it going to last? I don't know. Wish I did. It's never going to last forever. But right now, this is the easiest time in history to raise money for a technology company. And it's not just raising it, it's the speed at which you raise it, and it's your continuity of that program. Other things that are driving it, talent, obviously. I mean, some of the companies I meet in London just absolutely blow me away. The talent here is utterly incredible. And when you look at the confluence of the talent in those technology companies and the access to cash, I think London is in a very, very special place, and it's great to be around it. Also, I think that the low interest rates drive investment in technology. And finally, just a general desire and a general acceptance that it's now all about digital transformation. So with all that good news, why worry? I had to check the FT when I came in this morning to see what had happened to Greece. Greece is still there. Okay? You can still go on your holidays. You might not be able to get back again. You certainly won't be able to get any action from an ATM machine while you're there, but it's still there. People are worried about China, perhaps. Is it a property bubble? Is it an IPO bubble in China right now? Is that going to dry up all the cash reserves? Crowdfunding. What do we think about crowdfunding? Is it actually widening the gap? Do people need to get hurt before something really happens? Are people winning with crowdfunding? Is it fulfilling the gap? It's very, very early days, but I think generally it's a positive. I think anything which can basically help ordinary investors take part in something, I think is quite an exciting innovation. The two things I think that people, don't be worried about this, be mindful of this. two things are, number one, speed to market, and number two, the temptation for irrational exuberance versus logic. What does this mean? This means, you know what, let's just go and raise money, let's go and do some stuff, let's break stuff, let's not bother selling stuff. Let's not bother with that at all. Sorry, that's just not going to work. The combination of things that I think successful technology companies and how to get the attention of an investor is not just about the speed at which you can raise the money, it's the speed at which you can gain commercial traction as well. So they're the kind of companies that I want to go out and work with. I want to get mandated by those companies because I know they've got product. And if you take something as diverse and as mad as the ad tech sector right now, and there's a report that Pete sent me last night from Peel Hunt Stockbrokers, which is slagging off the ad tech sector, I think they're kind of missing the point slightly. It's to be expected. There's a gold rush in digital advertising. There should be a gold rush from the technologies that support digital advertising. The problem is that right now in the ad tech space, we've got 1,800 companies in Europe, all saying they can do the same thing for the same people and trying to raise money from the same people at the same time. Something's going to give there. But it's a good report, Peel Hunt Stockbrokers. It's worth having a look at. The High Velocity Club. What's this about? It's about really the acceleration, not just of sales and marketing rounds, and as Ben alluded to, the global conquest, that sort of viral type hub and spoke thing is quite exciting. The companies will fail quicker here as well. Why will they fail quicker? It's because better options are going to be available to both entrepreneurs and investors. And I don't think we're that great at that. I think we hang on quite a long time with some of the investments in this part of the world. I think the American mindset is probably more in tune with where we are right now, which is that they have a 1 in 10 type of a mentality approach, and perhaps Europe might be 1 in 5. Now, I like the fact that the European investors seem to be more prudent, but maybe there's a bit more of a balancing that has to happen there. And by the way, I'm not saying that the USA are, I'm not saying that we're years behind the USA. On the contrary, we're 8 hours ahead. Right, that joke never fails to really get everybody rolling around the aisles. Okay, so what do investors as a dragon look? What do investors look for? Number one, team. Number two, product. I would now wait. A few years ago, I might have gone half and half in terms of team and product, but now I'm telling you it is firmly 70% minimum about the team. Give me a good team and a crap business plan any day versus a good business plan and a crap team. You can really work with that. So for anybody raising money, your first slide is your team, okay? First 2 slides even of your team. The product, 30%, it's more about the fit. It's more about finding investors who don't go and talk to the whole market, seek out the investors who actually have the available cash, have experience, have a track record in this particular space, and can understand what you're talking about. So you're not spending 6 months financing their learning curve for them to go and invest in somebody else. There's lots and lots of opportunities out there, lots of resources for cash, more than ever before. Not just the support of government we have with terrific initiatives like EIS and SEIS, family offices, VCs, private equity firms, banks, and high net worth individuals, plus crowdfunding as well. I think on the EU side, investors like to know whether you're going to be a leader, an innovator, or an impersonator. There's nothing wrong with being an impersonator. For them, it suggests an exit. Hang on, if we can build this here in the EU, somebody in America who's doing the same thing are going to come along and buy us. There's an exit straight away. But know what you are and stick to what you are. And I think it's good to have ideas on exit as well, where you can paint the picture for an investor and tell them that these are just 5 bullet points. I mean, there are many, many more things investors look for, but for me, I think it's all about the team. Secondly, about the product. Does it fit with the investor's mindset, with their portfolio, and can they see, if they can see a way in with their money, they've got to be able to see a way out as well, all right? So, this unicorn picture, courtesy of Violaine, who's around here somewhere. Thank you, Violaine. So, dreaming of being a unicorn? A casual gallop down the beach, or more like this? Light speed is too slow. We have to go right to ludicrous speed. So the 2 things I want to leave you with: speed to market is about not just because you can raise the money, it's because you have to raise the money at speed to get the attention and to get the traction. And that's the way I believe it's going to be in the next couple of years. If it's not, then I apologize. I will completely retract everything I'm saying here today. Predictions. I think there will be an acceleration of the UK funding process because I think that the traditional funders of technology companies are going to hit back against crowdfunding. I think they've perhaps watched it develop, allowed it to develop, and I think like all things, we've seen it in the advertising space where big agencies watch the smaller digital agency grow, and then all of a sudden the bigger agency decides, no, we're now a digital agency. It's no different in terms of the financial services space. So that's going to happen. Number two, a greater focus on sales. I think it's where the EU can really set themselves apart from a lot of the American counterparts by demonstrating, hang on, yes, we have that successful fundraising track record, but hey, we've matched that with the commercial traction as well, particularly important in the space that I work in with technology. Collaborative portfolio investment deals where companies come together. Technology companies club together and basically maybe 4 or 5 companies go and raise money from the same fund. I like that. I think there's great strengths in that idea, economies of scale, et cetera, et cetera. I see a rise in new investment products that will mitigate risk. And above all, I think it's less time to market, less time to succeed, and less time to fail as well. I was allowed to put this in, but this is an initiative that I'm involved in at the moment. It is, as I said, it's all about sales, right? So indulge me for a second. But this is something which I've worked on with Pete, who's here today. And this is something we've tested for the last year. It's basically a product which enables companies trying to break into the UK market to be able to compete with UK companies here without the expense of sales teams or marketing teams or anything else. But take a look, it's called Martech Business Accelerator. And that's all from me. Thank you for being a lovely audience. And where do we go from there?
Thank you very much.
Okay.